Right now, the stock market is bleeding. If you're watching this, you've seen the charts. The NASDAQ is sliding, tech giants are shedding billions in value, and the AI honeymoon is officially over. We aren't in a total collapse yet, but for many investors, the panic is already setting in. We've seen this before, 2008, 2020. The market dips, everyone holds their breath, and eventually it recovers. But what if this time the dip doesn't stop? What if that 5% slide turns into 20, then 50? What if it kept falling all the way to zero? This isn't just a thought experiment. Every step of this collapse follows real economic mechanics, and by the end of this video, you'll understand exactly how a stock market crash could unravel everything. You might think the market just free falls, but it actually has built-in speed bumps called circuit breakers. They're designed to stop the bleeding before it gets out of control. Level 1, if the S&P 500 drops 7% in a single day, everything pauses for 15 minutes. It's a mandatory take a breath moment for the entire world. Level 2, if the panic continues and we hit 13%, another 15-minute halt kicks in. At this point, the room is officially on fire. And if we reach 20%, trading stops for the entire rest of the day. The market literally shuts its doors. But here's the scary part. Circuit breakers only pause the panic. They don't fix the underlying problem. And what's happening underneath is margin calls. Let me explain this like you're 5. Let's say you have $10,000 to buy stock, but your broker offers you a deal. They'll lend you another $10,000. Now you can buy $20,000 worth of stock. This is called buying on margin. If the stock goes up 20%, your $20,000 becomes $24,000. You pay back the loan and you're left with $14,000. That's a 40% gain. But if the stock falls 20%, your $20,000 becomes $16,000. You still owe the broker $10,000. That leaves you with only $6,000. You just lost 40% of your money on a 20% drop. Your broker isn't going to wait for you to hit zero. The moment your account drops too low, they call you. This is the margin call. They tell you, give us more cash right now or we are selling your stocks to get our money back. Most people don't have the cash, so the broker sells. That selling pushes the price down more, which triggers more margin calls for other people. It's a spiral that feeds on itself. It's not panic, it's math. At minus 50%, the spiral goes systemic. It's not just individuals anymore. It's pension funds, the money that pays for teachers, firefighters, and police officers. That money is in the market. When the market drops this far, these funds become underfunded. The money meant for your retirement literally evaporates. Either retirees get less or taxpayers have to pay more to fix it. But the real problem isn't the pensions, it's the plumbing. At minus 70%, the plumbing of the economy freezes. Most big companies don't keep enough cash to pay their employees every week. They borrow it short term, sometimes overnight through something called the commercial paper market. In a total crash, nobody wants to lend. If companies can't borrow, they can't make payroll. Suppliers stop shipping because they're not sure they'll get paid. Manufacturers stop producing because they can't get parts. Stores can't restock shelves. This happens in days, not months. At minus 80%, the wealth effect death spiral kicks in. Consumer spending makes up 2/3 of the entire economy, and the top 10% of earners account for almost half of that spending. When their portfolios are down 80%, they stop buying. No new cars, no vacations, no eating out. When they stop spending, businesses start laying people off. Now, the people who never owned stocks are losing their jobs because the people who did stopped spending. This is the death spiral. Falling stocks cause less spending. Less spending causes layoffs. Layoffs cause less spending. It's a loop that pulls everyone down, whether you have a brokerage account or not. And now we've arrived. The stock market hits zero. Every publicly traded company, Apple, Amazon, Walmart, is worth nothing on paper. Banks fail because their assets are worth zero. Insurance companies can't pay claims. Your home, car, and life insurance, gone. Government tax revenue vanishes. The system as we know it simply stops functioning. Here's the reality check. We've never actually hit zero. The closest we ever came was 1932, when the market fell 89%. It took 25 years just to get back to even. Today, we have safety nets, circuit breakers, the Federal Reserve, and deposit insurance. They're designed to catch us. But those systems are designed for crashes, not total collapses. They assume the market will eventually stop falling. The distance between a bad month and a total collapse is shorter than most people think.